Okay, there's there is something that I want to show all of you. There's one little thing that I'm sure a lot of you have already seen. Whoever's been with me, this is what the Nifty looks like, and over the last 30 years. So the blue line is the Nifty, the red line is the earnings, and you can see it's like a crocodile's mouth right now, which has never happened in the past. The Nifty is like there, and the earnings are like right down there. So that's the story. And the interesting thing, the green line is the historical or the trailing price earnings ratio. So a lot of you know that this is a measure of how overvalued or expensive the market is, and that's what a lot of us sort of follow. So this is the main question. Yeah, this is the crux of all that. After we learn everything, Rohit, what happens is everybody wants to know you're at a situation where the trailing P is at around 40. Okay, should we actually make a case? Should we actually make lump sum investments? I mean, there's a standard operating procedure to do the STP and the systematic transfer plan. You put some money into a debt fund and then slowly and gradually bring it to the equity area. But at this kind of a valuation, like the crocodile's mouth that I just showed it, the whole world, does it actually make a case for investment, or has something shifted dramatically? Are we really into a re-rating of P's? Are we like now, the band that used to be between 10 to 25 maybe, or that was the median, not even 10 to 25, say 15 to 25 was the median for the trailing P. Has it now sort of gone to 25 to 35? Is that the new band that we should start looking at? So it's the valuation thing. Ultimately that is what people get scared
Right.
also, that they don't want to come and invest at this time. STP is a standard procedure, but is something changed? Has something fundamentally changed with the P's? What do we look at it? Are we expensive really? I mean, that's a fundamental question. I'm sure you're answering that every day. So one more time, please.
No, no. So Karthik, when you look at valuations and you mentioned Nifty in your chart, right?
Yeah,
If you divide the stocks of Nifty, right, you have few stocks which are driving the valuations for Nifty, and there are a good number of stocks who are not even at their previous peak valuations, right?
right.
So
Of
it's the
course.
part of the market which has been doing extremely good because you can so call them the quality tier one of quality, right? Where you have no debt, you are the biggest leader in your business segment which you're into, and this money is putting into them, and the valuations are going higher, higher, higher. Or other part of the market, which maybe the tier two, tier three suppliers, they have the cyclical businesses, right, where you need things to turn around. Over there, they are still there where they were 4 years, 5 years back, right? So that's one part of the market. Secondly, when you look at Nifty as the index and we compare it 5 years, 10 years back, what was the averages, right? So as you know, Nifty is again, if you continue to perform well, you become a Nifty or a Sensex constituent, and the stocks which don't perform well, they get out. So if you look
Absolutely.
at last 2 years history, right? If I remember, like when I talk about Sensex and Nifty, the stocks like Kotak Bank and all, you have these performers who are high PE stocks, high PB stocks enter the benchmark, whereas you had Gale, Vedanta, and few other commodity names who exited, Bail. So these
That's
these
right.
were single P or low double-digit PE stocks, right? The
Correct.
stocks which have entered and entered with a bigger weight, they are like double-digit and high double-digit PE, mid-teens, high teens, early 20s, right? So even the constituent, which is now today than what was 5 years, 10 years back, nature of the businesses are different, the nature of the valuations are different. So but that apart, if I just look at the valuations today and historically, yes, even that gives me a little less comfort. If I'm investing into equities today, what kind of upside am I looking at it, or what kind of time frames? So as when you talk to investors, today if you come to me as an investor saying I want to invest for 6 months, my answer would you be to you, if I'm buying a stock today, I don't know what's going to happen for 6 months, right?
Yes,
It's
of
the view you're
course.
taking. So I mean, always you should have a slightly a longer time horizon. So what maybe even what we are seeing today is, see last year same time, like if you look the first half of calendar year 20, because of COVID and all, you had a very bad first half, right? So
Yes.
today, whatever the company reports does, YOY, we're entering a great phase of data. YOY, everything is going to look amazingly good, right?
Yeah, I know.
With businesses, what we have seen the commentary of corporates in this after the second quarter results and post that also. I mean, they're getting back slowly, right? The utilization levels are coming back, and when commodities are doing good, in a way, you feel the on-ground things are also improving, right? So that's what the whole thought is. Here you have fundamentals improving, but I would say that is more or less in the price, in the valuation which we see today. But it's just the hope, right? Things are improving. We are in a good trend. So maybe we don't make money for next 6 months. Maybe we don't go anywhere. But if you're a long-term investor, the compounding will happen. So that's one
Of
thing of it.
course.
So
No
that's
doubt
how
about
I
it.
see the market in terms of the entire diversified part of it. when I look at the NRNE portfolio and when I look at the valuations, that was the first starting point 6 months back, right? At what price am I buying these stocks today? So when I look at the BSE oil index and the BSE metal index, and when I compare it to Sensex, right?
Yes, yes.
It's at about 60% discount to the Sensex valuation, these companies, right? Whichever companies formed in the index, who are into oil and gas and energy. Same is the case with globally also. When I look at the MSCI Energy Index versus the MSCI World Energy Index, and there's a reason for it, right? These companies are cyclical, they have debt in their books. But here you're getting an option in
Right,
this.
right.
Here you're getting an option in this kind of a market environment where you're seeing fundamental improvements expected to happen, right? One, there's strong points for that to support that, and two, you have valuations also on your side.
Yes, wonderful. I mean,
So
it's
I
a
think
perfectly sweet
so.
spot.
I
Yeah.
think this is the. I mean, sweet so I don't know, but the data we are seeing right now, right? It
Yeah,
makes
yeah.
us believe that one part of the market is very expensive, but other part is seeing some change in cycle, and valuations are, I mean, nowhere there even to the previous peaks. That's how I
Agreed.
would divide the whole market part of it and this NRNE part of it.
I'm compelled to ask you, although this was supposed to be the last bit, but I'm compelled to ask you, when I saw that slide where it says that, we're at a 56% discount, so which means then everybody starts mentally calculating that if you're at a 56% discount or say 60% discount, that means the fund is going to give us 60% returns. That's how I know. That's how we think. But anyway, the jokes apart, what I'm compelled to ask you is when we say that these valuations are down to that level, there is also another very serious sort of a fear lurking everywhere, which is to say that with the amount of pollution and with the amount of carbon again going up, there might be a sudden situation where fossil fuels will get eliminated. So, which means, petrol, diesel, suddenly you will not have them. Today, we are talking about EV. The only challenge is to have charging points all across the country. And if I had the choice, I'm sure if you or anyone, Ayush or anyone had the choice, we would dump our diesel and petrol cars where we're paying 70% of that price we're paying as taxes, and we would just go and charge the cars in our houses or in our offices and just drive around on those electrical vehicles. So is that a threat? Because if that is a threat, then some of these oil companies, and not only in India but across the world, across the globe, uh, I mean, is that fear well found? Is there an apprehension which is well found?
So I would say what we talk today, after 2 years, the fear is going to increase.
Right.
We
Okay.
were speaking the same thing even 4 or 5 years back, right? In terms of the whole crude thing and how crude will go away, right?
Correct.
So yes, in the next 15 years, 10 years, we are heading towards that gradually, right?
Right.
But
Absolutely.
is it going to happen overnight in next 2 years? I don't think so. And when you take example of you and me, right? I mean, today buying an EV car, what is the availability? What is the pricing? Forget the infrastructure of where you're going to charge it. Today we all stay in buildings, right? Apartments
That's
where
right.
you have a 20-floor apartment and all. Either and plus the affordability is not across categories of people, right?
Correct.
So
Correct.
yes, we are moving gradually towards it, no doubt. Government from their side is doing the right things, in terms of intensifying. But will in 2 years you will see no petrol cars, and I would ask why are some auto companies trading at these valuations what they are,
Exactly.
right? So I mean, it's like
Yeah. Yeah.
you're going to move towards that thing, but it's going to take time. It's going to be a
Hmm.
slowly gradual process. So same thing goes for your OMCs also, right?
Right.
Today you have a X number of sorry cars on the street, right?
Right.
If for example, I mean, and it's a very hypothetical. If you say after 2 years, they're not going to be any fossil fuels cars sold, right? But what about the cars which are there on the street? They are going to need petrol and diesel, right?
Yeah. Yeah. Yeah.
So
You need
yes,
so much of power
yes,
to even destroy them.
yeah. So as a concept theory, even we want that to happen gradually, but everything has its own time, right? So to take that call now and say, okay, I'm not going to own these stocks at all,
Hmm.
and when you're seeing those data points, I think that's the relationship one should look at it rather
Okay.
than just saying that 10-year call, because we never get a 10-year. I mean, let's talk about crude, right? Crude, when shale came up, the view was $55 is a break even. It went to $30, it went to negative, right?
Yes.
We never saw any investment thesis talking about it at this price. Shale is not viable. So the demand, which I think 10 to 11 billion barrels per day US produces by a shale, that will go down to zero supply. It's never spoken about, right? We forget things.
Yes. Of course.
So yes, I mean, it's a possible 5 years down the line when you ask me the same question, if this has not happened or we are not there at least 30-40%, I'll be surprised.
Hmm.
For the next few years, it gives me the comfort, right? At what levels I'm entering into and what is the line or what is the speed of change happening.
Correct.
I mean,
So it's not going to be so dramatic, is what you're saying.
I would be very, very, very surprised.
Yes. So which means, we can benefit from traditional companies and traditional investments also, and there is also a lot of pocket of opportunity which is slowly and steadily emerging.